Folks, before we jump into today's video, I want to take a minute to thank everyone for joining my Smart Money Spike alert service. If you haven't done so yet, there might be a few spots left. You might want to check. Alert is going out today and you don't want to miss it. Click the link below and see if it's still up. All the details you need are still there. Now, let's get started. Today I want to tell you about one of the most powerful indicators out there. It's an extremely unique one because unlike 99% of indicators, this one does not rely on the security's price or even its trading volume as an input. Instead, it compares the ratio of put to call options that are being traded on a stock or an ETF. It's a way to gauge sentiment. Are investors extremely bullish? Are they bearish? Are they somewhere in between? If you know how to use it, it can lead to explosive trades with a fantastic risk to reward ratio. Here's what you need to know about the put to call ratio. Pay attention, it's one of my favorite fading indicators. Folks, I want to talk to you about one of the best contrary indicators. I know the last few days we've been talking about fading strategies. The Smart Money Spike strategy, it's a fading strategy. And a lot of traders, a lot of beginners have been sending me emails saying, Roger, can you give us some more info? This is exciting. This is so cool. It makes perfect sense. I love it. I love it. I love it. So this is a really good example of the put to call ratio. So let me show you this. Let me make the chart a little bigger actually. So you guys can see a little, get a little better view of what's going on here. So again, this is the put to call ratio. And typically, the put to call ratio is random. Now you're thinking to yourself, why are you showing this to me if it's random? Well, it's random, but sometimes it's meaningful. And that's the only time we focus on it. So let me give you the analogy of how it works. When traders buy a huge amount of calls in comparison to puts, a really extreme level of calls compared to puts, the market turns and snaps the other way. When traders buy a huge amount of puts, when their fear level is just out of whack, when they think the market's coming apart, the market turns. And believe it or not, this happens almost every time, 9 out of 10 times. Let me give you an example. So typically you see that the put to call ratio, this is I think a year or 2-year chart. You could see that the put to call ratio hangs around 0.75 on average and then goes up to about 120, 125. That's random. Most of this activity, 95, probably 99% of this activity is random. But sometimes the ratio gets really high or really low. So let me explain to you the meaning of it. If you see a put to call ratio at 65 or lower, all right, that means the market is extremely bullish. Extremely bullish. And when market gets really bullish, what happens? It flips. Just like here. End of December, notice market became really bullish. It went back to neutral. Take a look at this example. This is the market. This is the S&P 500. Look at, and this is the holidays last year. Remember when this little thing happened when China and US started their the trade war? Markets were going south. Traders, investors, fund managers, everybody who would talk said it was the worst, the biggest decline in history. As a matter of fact, during this period of time, the Dow Jones had a few of the worst days in history. Well, this is what happened to the put to call ratio. The put volume spiked like crazy. It went all the way to 180. Notice the highest, even peaks were like 130, 135. And this happened, I saw this, and I created a video, I remember well, and I said, folks, it's done, it's over. This isn't going anywhere. The ratio of puts to calls is so high that the market's going to turn around. And everybody, I was getting hate letters. People were saying to me, Roger, there's no way you could know that. Look at the market, it's dropping. We're well below the 200-day moving average, the 50-day moving average. Volume is high. The world is coming to an end and so forth. And I said, no, it's not. Put to call ratio, it's at 180. That's the highest level we've seen in years. And guess what happened? The market turned around, went bullish, and went on a beautiful bull run and gave us a 31% return. All right. Again, you see this little upside here that we had? This little up part right here, that when the S&P made an all-time high, everybody you would listen to would be telling you that the market's going higher, higher, higher. Well, look at this put to call ratio. It went below 65. And what happened? Coronavirus. The market sold off, and let's look at the chart. You'll be able to see it a little better example of what I'm showing you right now. But we're talking here, here's a 9-month. See that sell-off right here we're having? And I think we're going to go a little further. We're selling off, and I think the market's going to break the 50-day moving average. Why? Because the put-to-call ratio has been so low. So again, typically the put-to-call ratio is random, and it doesn't mean anything. But whenever you see an area, and this is the entire market, this is the put-to-call ratio, end of day. This is only valid end of day, and again, 95, maybe even 99%, it's pointless, it's random. But if you see a real wild put-to-call ratio, any number about 135, 140, that means the market is extremely bearish and bulls are going to start gaining control. And if you see the put-to-call ratio below 65, like you do here, even below 70, it's telling us that the bulls are getting tired and market is going to flip. And again, this indicator is only useful about 2% of the time when the ratios get extreme. But when it does, then it works like a charm. It has a success rate of about 95% over the last 10 years, if you look at the extremes. So this is looking at the put-to-call ratio gives us a whole market approach to fading strategies and shows you exactly how effective they could be. Because the put-to-call ratio is the biggest example. It's the most extreme example of fading strategies, because I'm going to tell you, when the put-to-call ratio is at 180, that means there's like two to three times as many puts, almost 2 to 1 put buying versus call buying. And what happens? The market turns. Same thing when we get to 0.65. The call buying versus put buying is extreme. What happens? The market turns. But here's the thing. It doesn't happen sometimes. It doesn't happen 6 out of 10 times. It happens almost every time, like clockwork. And that's how easy and how predictable fade strategies are. And that's why when you're a beginner trader, you don't lose little by little. You lose a lot quickly. Look at your accounts. Look at your account when you first started out. You lose much quicker than you gain. And that should tell you a lot, especially the fact that markets are not random. If they were, this put-to-call ratio wouldn't work, and traders would lose money very, very slowly. The biggest difference wouldn't be the gains and losses. It would be the commission. And I could tell you, and you could probably tell me that's not the case. The commission is not what gets you. It's the huge loss that happens to your account that causes you to go to belly up a few times. And it happens to everyone. When I first started out, I started with $5,000. And I took it up to about 27, 28. I don't remember the exact number, somewhere close to 30,000 in 4.5 months. And I went back to 5,000 in like 3 weeks. So I'm going to tell you, traders lose money much, 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 much faster than they gain. And that should tell you markets are not random, and fading strategies work amazingly well. If you don't believe me, just look at the put-to-call ratio and look at the peaks and valleys in the S&P 500 and look at every time what happens when the put-to-call ratio gets extreme. It flips. I hope that helps, and I hope that gives you and explains and teaches you the value of following retail traders and fading. Not following retail traders, fading what they do. Hope that helps. Folks, when it comes to trading, you almost want to bet against the retail traders. In my experience, and I've been doing this for about 26 years now, they lose over 70% of the time, more sometimes. And that's exactly why I created the Smart Money Spike strategy. It lets you bet against traders using outdated strategies. Not surprisingly, the system so far has a 70% plus win rate and a profit factor of close to 5 to 1. That means for every dollar you risk, you make $5 back over time. My next Smart Money Alert is going out today. Like I said, there might be a spot or two left. If you want to join, click the link below. You'll get all the details. See if there's spot left on this page. Alerts are going out today. You don't want to miss out on this service. Talk soon.